You're going against the trend here. And as you said in the break, I mean, it's not like 145,000 is bad, but it's definitely below consensus. So what got you there?
Yeah, I mean, it's not a bad number. It's still a solid pace of job growth, kind of where we were running before we had the very strong 300K plus prints in December and January. So that's really the crux of our forecast, is that we do see signs that hiring is slowing down, that it is taking longer for people to find work if they do lose their jobs. There's still not large outright layoffs, but we're basically expecting that trend back from October, November to show up again in softer private services payrolls.
So you've got, I mean, that is a left-hand call, 145,000. So let's see. And it's good to be a little bit contrarian, because consensus is so concentrated at the moment in this bullish narrative. But you do go for a slightly higher wages number. Can you square those two away from me?
Yeah. I mean, they are somewhat related. I mean, we've definitely seen this slowdown in hours worked, and that is usually a leading indicator, for labor market activity pulling back. And that strong wages number that we had in January, we had a 0.6% average hourly earnings.
Yeah.
That was because hours worked fell a lot, and I do think maybe consensus is looking for hours worked to rebound a bit more than we're expecting. But that trend is still falling, and there are just some maybe mechanical issues where we're maybe losing workers in relatively lower wage jobs, and that does boost the average wage.
I mean, this is the thing. We have sort of pinned expectations to 353,000 that we got last month. And that kind of figures has meant that all of the bears on this economy have decided to throw in the towel. You had Deutsche Bank, who was one of the first to call a recession, say, hey, maybe we're not going to get a recession. But Veronica, you and the team are still sticking with this call. Why are you not swayed by the recent data?
Yeah, we really are just trying to step back and not get too overwhelmed by whatever the last monthly data point was. There does seem to be a lot of recency bias out there, and we're really just looking at the bigger macro trends. And we have seen 4, 5, 6 months at least of hiring slowing down and hours worked pulling back. All those early signs that you would expect to see 6 to 9 months before you get a weaker labor market. And these things can happen non-linearly, like layoffs are really the last step in that equation. And we are still looking to see that maybe as we're getting to the spring. There are issues of reading into December and January data where it's a low activity period anyway. You're already losing a lot of jobs. There's very positive seasonal adjustment issues. And we are getting past that now with this February print.
So with that recession call still there, a lower jobs number, idiosyncratic wages rising, I take it then you're going to take the other side of the trade. This market is moving to less than 3 rate cuts, the possibility of 1 rate cut. And if you go to the outside of the left tail, it is Apollo at none. So where are you, given your recession call and the timing of those cuts? Yeah,
we do think the Fed will start cutting in June, but we're penciling in 125 basis points this year. So that's June and every meeting after June. And partly that is premised on by the time we get to cuts in June, I do think you'll see some clearly weaker activity data, and the Fed would be cutting every meeting then.
So if we have that environment where the Fed starts to cut every meeting, we go into recession. What does the way out of recession look like? How difficult will it be to get real and sustainable growth back into this economy?
Yeah, I mean, we're not penciling in. I mean, some people maybe call it a mild recession. We would say maybe a run-of-the-mill recession. We're not expecting a deep downturn like a 2008 or a 2020, of course. But this is just a recession because rates are restrictive and things slow down. And when the Fed does come in and start lowering rates, I mean, I think you would be coming out of it as we're getting into next year. But it is almost that type of slowdown that's needed, I think, to really get inflation under control. And January CPI was a good example of that. We've just not seen the evidence of a true soft landing. You'll either have the slowdown or you'll have some sticky inflation.
Let's just challenge, because you are coming on with a non-consensus view. So the guidance from the Fed at the moment is potentially 3, less than 3. I know we'll see with the dots, but you're saying that it's going to move at each meeting. And here we are, we're being guided that it could well be 1 in the autumn and done. So you really are pushing against the wind. What makes you convinced that this time the cycle of cutting will be similar to the past? Because that's not what we're being guided either by Lagarde or Powell?
Yeah, I mean, it really does come down to the activity data. You know, what if we do see the labor market slowing more? I think that is a situation where the Fed themselves would expect that they're cutting a lot more. So it really does come down to that. I mean, if we do have activity data holding up, if we don't get the recession, it does still seem like, you know, Powell, the Fed wants to be cutting as we're
Is it
getting
the real
to the
rates
summer.
narrative? I mean, Danny and I were just chatting about this morning. Is it at any level a real rates headwind in this economy?
Yeah, I mean, I think they are probably worried about that. I think they probably saw the same signs that we did last fall, that the labor market was loosening, and they really do want to avoid that recession. And so they're willing to cut and maybe sacrifice the inflation mandate a little bit in terms as we're getting there, yeah.